At 4 o'clock on a Tuesday morning, a single mother in Ohio starts her car to begin a shift that will barely cover the interest on her credit card debt. At that same exact moment, an institutional algorithm in a data center in New Jersey executes a high-frequency trade that generates more profit in 6 milliseconds than that woman will earn in 3 years. This isn't a coincidence. It isn't a failure of the system. It is the system functioning with mathematical precision. Most people spend their entire lives believing that the economy is a ladder where hard work leads to the next rung. But the reality is that the financial system is not a ladder, it is a filter. It is a highly sophisticated mechanism designed to separate those who understand the mechanics of money from those who merely use it. There is an invisible threshold in the banking world. On one side of that line, money is a tool for survival that must be traded for time. On the other side, money is a self-replicating asset that renders time irrelevant. This script explores the mechanics of that divide. Before the breakdown of how these tiers actually operate, clicking the subscribe button ensures access to future dissections of the hidden structures that govern the global economy. This channel is dedicated to observing the patterns that most institutions would prefer remain obscured. The fundamental tension in the modern economy begins with a concept known as the Cantillon effect. It is a principle that dates back to the 18th century, yet it governs every digital transaction made today. The Cantillon effect observes that when a central bank creates new money, that money does not enter the economy evenly. It enters through the hands of the state and the banking system first. By the time that new money reaches the average worker in the form of wages or consumer spending, the prices of assets like real estate and stocks have already been driven up by the people who received the money first. What tends to happen is a silent transfer of purchasing power. The people at the end of the line see their costs rise before their incomes, while the people at the front of the line, the winners in this system, get to spend the new money while prices are still low. This is the first and most significant way the system separates the classes. It isn't about how much someone earns, it's about their proximity to the source of money creation. Consider the math of a typical savings account. When a bank offers a 0.5% interest rate while the real inflation rate sits at 6% or 7%, the person holding cash is effectively paying a 6% tax for the privilege of letting the bank use their money. The data suggests that for the majority of the population, saving is actually a slow-motion wealth destruction strategy. Meanwhile, the institutional tier understands that cash is a melting ice cube. They don't save, they rotate. They move out of currency and into hard assets that the central bank cannot print. This creates a divergence where the laboring class works for a currency that is losing value, while the asset-owning class owns the things that the devalued currency is chasing. The gap doesn't widen because one group is working harder. It widens because one group is holding a bucket with a hole in the bottom, while the other group owns the well. The physical analogy for this is a treadmill. The person on the treadmill is running at 10 miles per hour, but the belt is moving backwards at 11 miles per hour. No matter how much effort is expended, the runner is actually moving further away from the wall. This is the lived experience of millions of people who receive a 3% raise in a year where their rent increases by 10%. The system is designed to keep the belt moving just slightly faster than the average person can run. Why? Because a population that is constantly running to stay in place is a population that provides a steady stream of cheap labor and predictable consumption.
When the conversation shifts to debt, the divide becomes even more stark. In the lower and middle tiers of the economy, debt is a weight. It is used to purchase depreciating assets, or to bridge the gap between income and basic needs. This is consumer debt, and it carries high interest rates that act as a friction on every dollar earned. However, for those on the other side of the divide, debt is not a weight, it is a lever. High net worth individuals and corporations use what is called debt arbitrage. If an institution can borrow money at 3% and invest it in a project that yields 8%, they have effectively created a 5% return out of thin air, using someone else's money. The math shows that the wealthiest entities in the world are often the most heavily indebted, but their debt is productive debt. It is structured in a way that the asset pays for the liability, leaving the owner with the spread. The banking system facilitates this behavior through the way it assesses risk. A person looking for a $20,000 car loan is viewed as a liability. They are subjected to high interest rates and rigorous scrutiny. But a corporation looking for a $200 million loan to acquire a competitor is viewed as a partner. They are given prime rates and favorable terms. This creates a feedback loop where the winners are given the cheapest tools to grow, while the rest are charged a premium to survive. It is a systemic bias that rewards scale and punishes the lack of it. Now, some might think that the solution is simply to spend less or be more frugal, but the math of the modern economy often makes that impossible for the bottom 60%. When the cost of housing, healthcare, and education, the three pillars of the American dream, outpaces wage growth by hundreds of percentage points, the math of frugality breaks down. Between 1980 and today, the cost of a college degree has risen by over 1,000%, and the median house price has detached entirely from the median income. The pattern that emerges is one of structural entrapment. People are forced into debt cycles not because of poor choices, but because the entry fee for a stable life has been inflated beyond the reach of a standard salary. Psychologically, the system relies on a concept called hedonic adaptation, but with a financial twist. The consumer economy is engineered to ensure that as soon as someone earns more, they are presented with new, necessary expenses that keep them in the labor force. The psychological insight here is that the feeling of winning in the consumer world is often tied to the ability to buy things, whereas true winning in the financial system is tied to the ability to buy time. The majority of people are conditioned to trade their time for symbols of wealth, while the actual winners trade their wealth to reclaim their time. The tax code is perhaps the most explicit map of this separation. In almost every developed nation, the tax code is bifurcated. There is one set of rules for those who trade time for money, W-2 employees in the US, and another set of rules for those who provide capital or own businesses. For the employee, the tax is taken off the top before the money ever hits their bank account. They are taxed on their gross income. For the business owner or the sophisticated investor, they are taxed on their net income. They are allowed to spend on business expenses, travel, equipment, interest, even some living costs before the government takes a cut.
What tends to happen is that the person earning $100,000 a year as a specialized employee often pays a higher effective tax rate than a billionaire who is living off of loans taken out against their stock portfolio. This is a technique known as buy, borrow, die. An individual buys an asset, waits for it to appreciate, borrows against that appreciation to fund their lifestyle, which is not a taxable event because a loan is not income, and then holds the asset until they pass it on to heirs, often with a stepped-up basis that wipes out capital gains taxes. The math of this is indisputable. The system is designed to tax movement and labor while shielding static wealth and capital. Who profits from the audience not knowing this? The answer is the institutions that act as the intermediaries of the system. Banks profit from the spread, the difference between what they pay you for your deposits and what they charge others to borrow that same money. If everyone understood the mechanics of the Cantillon effect and the reality of negative real yields, the banking system would face a massive liquidity crisis as people pulled their money out of stagnant accounts and into productive assets. The financial services industry also profits from complexity. By making the rules of the game appear incomprehensible to the average person, they can charge fees to act as the gatekeepers of wealth. There is also a political incentive to keep these mechanics obscure. A population that understands that their purchasing power is being systematically eroded by monetary policy is a population that becomes difficult to govern. It is much easier to blame the other side or specific corporate villains than it is to address the fundamental architecture of the global monetary system. The winners in this system are those who have moved past the emotional distractions of the news cycle and focus entirely on the cold, hard flows of capital. Let's look at the concept of the velocity of money. In a healthy economy, money moves quickly. You pay the baker pays the miller buys a new truck. However, in a system where wealth is concentrated at the very top, the velocity of money slows down. The extremely wealthy cannot possibly spend enough to keep the economy moving on their own. Instead, they park their wealth in assets. This leads to asset price inflation. This is why you can see a stock market hitting all-time highs while the Main Street economy feels like it is in a depression. The two are no longer linked. The winners are living in the asset economy, while everyone else is living in the service economy. The research shows that this separation is accelerating. With the advent of artificial intelligence and advanced automation, the value of labor is being further decoupled from the creation of wealth. In the past, if a company wanted to grow, it had to hire more people. Today, a company can grow its valuation by billions of dollars while actually reducing its headcount. This means that the labor-capital gap is becoming a canyon. People who rely on a paycheck for their survival are finding that their leverage is evaporating. The only people who benefit from this shift are the ones who own the software, the hardware, and the land. Now, you might be thinking, if the system is this rigged, why doesn't it just collapse? The answer lies in the middle-class buffer. The system creates just enough winners to keep the hope alive for everyone else. It provides just enough access to credit and just enough consumer goods to maintain a standard of living that feels acceptable. As long as the average person has a smartphone and a streaming service, they are less likely to question why their share of the total national wealth has been shrinking for 40 years. The system doesn't need to be fair. It only needs to be tolerable.
The behavior of institutions during a crisis reveals the true hierarchy of the system. When a major bank or a massive corporation faces insolvency due to poor risk management, the response is often a bailout or liquidity injection. The rationale provided is that these entities are too big to fail, in that their collapse would destroy the economy. However, when an individual or a small business faces the same situation, the response is market discipline. They are allowed to fail, their assets are liquidated, and they are removed from the game. This observation shows that risk is socialized for the winners and privatized for everyone else. The winners have a safety net, everyone else has a trapdoor. The math of compounding is often cited as the eighth wonder of the world, but what is rarely discussed is that compounding requires a baseline of stability that most people do not have. To benefit from compounding, one must be able to leave their money untouched for decades. This requires a level of cash flow that covers all emergencies, health crises, and economic downturns without touching the principal. For someone living paycheck to paycheck, an unexpected car repair or medical bill isn't just an expense, it is a reset button on their ability to build wealth. It breaks the chain of compounding. The system separates winners from everyone else by ensuring that the majority of people are constantly forced to break their compounding just to survive. Consider the physical reality of the invisible threshold. In the world of private banking, once an individual has a certain amount of liquid assets, usually starting around $10 million, the rules of the world change. They are no longer sold products, they are offered solutions. They get access to private placements, hedge funds, and direct indexing tools that are legally unavailable to the general public. They can borrow against their art collections, their wine cellars, and their stock portfolios at rates the average person couldn't dream of. They're invited into a parallel financial universe where the goal is not to earn money, but to preserve and grow it. This threshold is where the separation becomes absolute. The winners are no longer playing the same game as the rest of the world. The psychological impact of this separation is profound. People in the everyone else category often experience financial chronic stress. This state of being narrows the focus to the immediate future, paying the rent this month, buying groceries this week. This scarcity mindset actually lowers the cognitive ability to make long-term strategic decisions. In contrast, those on the winning side of the system have the luxury of the long view. They can make decisions based on what will happen in 10 years, not 10 days. This cognitive gap further reinforces the divide. The system doesn't just take people's money, it takes their ability to think clearly about how to get it back. The critique of the system isn't necessarily a moral one, it's a functional one. A system that concentrates wealth to such an extreme degree eventually loses its foundation of consumers. But the current architecture has found a workaround, the subscription economy. Instead of people owning houses, cars, software, or even music, everything is being converted into a recurring monthly fee. This ensures a permanent flow of wealth from the laboring class to the asset-owning class. You don't own your life, you rent it from people who own the infrastructure. This is the ultimate separation. The winners own the subscriptions, and everyone else is a subscriber.
The math of this subscription economy is devastating over a lifetime. A person might pay $500 a month across various subscriptions for 30 years. That is $180,000 that has zero residual value. If that same $500 had been used to purchase an appreciating asset, the outcome would be a massive nest egg. But the system is increasingly designed to make ownership difficult and renting easy. This is a deliberate choice made by corporations to create sticky revenue streams that investors value. The winner in this scenario is the shareholder of the subscription company. The everyone else is the person whose bank account is automatically debited every month. There is also the matter of information asymmetry. In the stock market, the institutional players have access to data feeds that cost $24,000 a year per terminal. They have analysts who do nothing but pore over satellite imagery of retail parking lots and shipping lanes. The individual investor is getting their news from social media or mainstream outlets that are often hours or days behind the reality of the market. The system is designed to ensure that by the time everyone else hears about a great opportunity, the winners have already bought in and are looking for someone to sell to. The retail investor is often the exit liquidity for the institutional player. The question then arises, why is this not taught in schools? Why is the curriculum focused on how to be a good employee rather than how the monetary system actually functions? The answer is found in the origins of the modern education system. Much of it was designed during the Industrial Revolution to produce disciplined workers for factories.
The goal was to create a population that was literate and numerate enough to follow instructions, but not so economically literate that they would challenge the structure of the economy. To this day, the education system focuses on earned income and ignores passive income, capital gains, and tax strategy. The winners benefit from a population that views a paycheck as the only path to security. The reality is that the money system is a game with two different rulebooks. One rulebook is given to the public. It emphasizes saving, working hard, and playing it safe. The other rulebook is used by the winners. It emphasizes leverage, tax efficiency, and asset ownership. The two books are not just different, they are often contradictory. What is considered safe in the public rulebook, like holding cash, is considered guaranteed loss in the winner's rulebook. What is considered risky in the public rulebook, like using debt to buy assets, is considered standard practice for the winners. The data suggests that the winners are also increasingly geographically and socially insulated. They live in the same zip codes, send their children to the same schools, and sit on the same boards. This creates a closed loop of information and opportunity. A person born into the everyone else category doesn't just lack money, they lack the social capital and the informal knowledge that is passed down in these circles. They don't know who to call to get a deal done, and they don't know the unwritten rules of how wealth is moved. This social separation is just as powerful as the financial one. Now, you might be thinking that this sounds incredibly cynical, but look at the math of the last global financial crisis. In 2008, when the housing market collapsed, millions of families lost their homes. At the same time, private equity firms were given massive amounts of low-interest credit to buy up those same foreclosed homes. Today, those firms are some of the largest landlords in the world, and families who lost their homes are now paying rent to the firms that were bailed out with their tax dollars. This is not a conspiracy. It is a recorded historical fact. It is a perfect example of how the system uses a crisis to further separate the winners from everyone else.
The systemic critique here is that the current money system is not designed for stability or for the flourishing of the majority. It is designed for capital efficiency. In a system that prioritizes capital efficiency above all else, human beings are simply another input to be optimized. If it is more efficient to replace a human with a machine, the system will do it. If it is more efficient to devalue a currency to pay off sovereign debt, the system will do it. The winners are those who have positioned themselves to be on the side of the efficiency, rather than being the input that is being optimized. The transition from everyone else to the winner category is not a matter of working more hours. There are only 24 hours in a day, and labor is inherently limited by time and physics. The only way to cross the threshold is to change the relationship with money. It involves moving from a linear income model to a non-linear income model. Linear income is, I work an hour, I get paid an hour. Non-linear income is, I own an asset and it pays me regardless of what I do with my time. The system is designed to make this transition as difficult as possible. It surrounds the individual with temptations to consume and barriers to invest. Consider the role of the financial advisor in the retail world. Most of these advisors are actually salespeople for the banking industry. They steer clients into mutual funds that carry high fees and rarely outperform the broader market. These fees might seem small, 1% or 2%, but over a 40-year period, a 2% fee can eat up to 50% of the total potential value of an investment portfolio, due to the loss of compounding. The winners don't use these retail products. They use specialized family offices and tax strategists who are paid to minimize fees and maximize after-tax returns. The system profits from the everyone else group's desire for a hands-off approach to their finances. The banking behavior of the modern era has also introduced a new level of separation, financial surveillance and debanking. As the world moves toward a digital-only economy, the ability of an institution to simply turn off a person's access to their money is a new and terrifying power. We have already seen instances where individuals or groups have been cut off from the financial system for violating terms of service or for their political activities. The winners in the system ensure they have sovereignty. They hold assets in multiple jurisdictions, they own physical gold, and they understand how to use decentralized finance to ensure they can never be fully turned off. Everyone else is entirely dependent on the permission of a few large banks to participate in the economy. The physical analogy here is a gated community. In the past, the gates were made of iron and stone. Today, the gates are made of credit scores, know your customer, KYC regulations, and minimum balance requirements. If you have the right score and the right balance, the gate opens, and you are welcomed into a world of opportunity. If you don't, you are left outside, where the costs are higher and the protections are fewer. The system doesn't need to build walls when it can simply use an algorithm to exclude you. What tends to happen when this information is presented is a feeling of overwhelming complexity. This is also by design.
The more complex the system appears, the more likely the average person is to simply give up and accept their place in it. But when the jargon is stripped away, the math is actually quite simple. It is a game of inflow versus outflow and asset versus liability. The winners maximize their inflows from assets and minimize their outflows to taxes and interest. Everyone else does the opposite.
The reason this information is rarely discussed in the mainstream is simple. The mainstream media is part of the system. It is funded by the very banks and corporations that profit from the status quo. Their goal is to keep the audience focused on micro events, the daily fluctuations of the stock market, the latest political scandal, or the newest consumer trend. They rarely, if ever, discuss the macro structure, the way the very nature of money itself is used as a tool for social and economic engineering. To discuss the invisible threshold is to pull back the curtain on the Wizard of Oz, and those behind the curtain have a lot to lose. The patterns we have observed, the Cantillon effect, the debt lever, the tax code bifurcation, and the subscription economy, are not temporary glitches. They are the bedrock of the global financial order. The system isn't broken. It is working exactly as it was designed to work for those who hold the pens that write the laws and the keyboards that print the money. Understanding these mechanics is the first step toward recognizing the reality of the world we live in. Those who ignore the math are destined to be its victims, while those who observe the patterns are at least able to see the treadmill for what it is. This channel focuses on these invisible structures because the data suggests that the divide is only going to grow. The winners are already preparing for a world of even greater automation and digital control. The everyone else category is being led toward a future of universal basic income and permanent renting. The choice of which side of the threshold to aim for is the most consequential decision a person can make, yet it is a decision most people don't even know they are allowed to have. Reinforcing this knowledge is difficult because it requires a complete revaluation of what security means. In the old world, security was a job and a savings account. In the new world, security is the ownership of productive assets and the understanding of how to navigate a system that is designed to be a filter. The information shared here is the result of observing how the world's most powerful institutions actually behave, rather than how they say they behave. This is why these topics are rarely found in textbooks or on the evening news. The system operates best when its mechanics remain invisible to the people who are being filtered. By observing the math and the patterns,